Welcome to the Deep Dive. Today we're digging into PepsiCo's third quarter 2025 earnings call and all the related financial docs.
That's right. And if you need the quick version, the real shortcut to understanding how a giant like PepsiCo is handling things, you're in the right place.
We want to know how they're navigating these, well, tricky volume challenges.
Exactly. And executing this massive portfolio shift, especially towards health and wellness, plus, how they're really pushing urgency on costs.
Okay, so let's start with the top line numbers, the Q3 snapshot. Reported net revenue growth, it actually sped up a bit to 3%.
Yeah, 3% reported in Q3. And organic revenue, which is cleaner, that was 1% for the quarter. So steady.
Steady, okay. But then you look at the profit. Reported operating profit just plummeted, down 8% in Q3.
And wait for it, down 25% for the year so far.
Whoa, 25%. That's a huge disconnect from the revenue side.
It really is. But the call explained it pretty clearly, that massive gap, and it's mostly because they took some big hits on the books.
Yeah.
Items affecting comparability, they call it.
Right, cleaning house financially.
Pretty much. Nearly $2 billion in impairment charges this year. Writing down brands like Rockstar, Be Cheery, stuff like that.
So a big financial hit, but maybe one they needed to take to move forward.
That seems to be the thinking. Get the pain out of the way, which is why, management didn't seem overly panicked.
Yeah, they actually affirmed their full-year guidance for 2025, right? Still looking for low single-digit organic revenue growth.
And core constant currency EPS, basically flat compared to last year. So despite the reported profit drop, the underlying core outlook holds.
And they got a little bit of good news on the currency front, too.
A slight tailwind, yeah. The foreign exchange hit they were expecting, it looks like it'll be smaller now, down from a 1.5 percentage point drag to just 0.5 points.
Okay, every little bit helps, I suppose.
Definitely, especially when you're dealing with those internal transformation costs.
All right, let's really unpack the core issue here. This tension, it's always there, isn't it? Volume versus price.
The classic CPG balancing act.
PepsiCo's been leaning hard on pricing, you said, a 4% impact, both Q3 and year-to-date.
Exactly, 4%. Effective net pricing doing the heavy lifting for revenue.
But the consequence is people buy less, volume declines, especially, it seems, in North America.
Precisely. Let's look at North America beverages, PBNA. Organic volume dropped 3% in Q3.
Okay, 3% down. How does that break out?
Well, it's interesting. Carbonated soft drinks, like Pepsi itself, flat volume, which is actually pretty good in this environment.
Flat is the new up, maybe.
Yeah, maybe. But the non-carbonated beverages, that segment fell 6%. That's where the main drag was.
6%. So still waters, juices, teas, that kind of thing. But what's the story there? Management blamed service levels earlier in the year.
It did. They said, look, we had system transition issues, service levels dipped, but now we're fixed. Like 97, 98% service levels. Very high.
And they think that alone explains the drop and predicts a recovery. Seems optimistic.
Well, they are optimistic it'll drive acceleration, but here's a key piece of context they offer.
Okay.
If you take out case-packed water, which is a specific area they're shifting strategy on, lower margin stuff if you exclude that, PBNA volume actually grew in the quarter.
Ah, okay. So the core business, excluding that water shift, is actually showing some strength.
Yeah.
That changes the picture a bit.
It does. Makes the service level argument maybe a bit more plausible, or at least less of the whole story.
Got it. So while beverages might be seeing some underlying recovery, what about snacks? PepsiCo Foods North America, PFNA, also down?
Also down 3% volume in Q3, yeah.
Yeah.
And within that, savory snacks like chips dipped 4%.
Similar drop, but you're saying the reason is different, not service levels.
Totally different, according to them. This was a conscious choice. It's about promo strategy.
Promo strategy, how so?
Well, last year, summer 2024, they did these really deep discounts on specific big brands. Drove volume, sure, but maybe hurt margins. This summer. They shifted. Less deep discounting, more focus on everyday low value, spread across all the brands.
Ah, so they expected volume to take a hit, but they got better? What, revenue realization?
Yeah.
Better margins per sale.
Exactly. Better revenue realization. They traded some volume for healthier profit on what they did sell. And they sound pretty confident about it.
How confident?
They mentioned seeing volume growth in the last 4 weeks of the quarter, actually. And they expect the foods business to be pretty much flat, volume-wise, in this current quarter, Q4.
Okay, that suggests they feel they pulled the right lever there. Disciplined.
Very disciplined. Volume management for value.
But it still leaves the big question.
Yeah.
How do they get the whole company back to hitting those long-term growth targets they always talk about? For 2026, What's the game plan?
Yeah, the pressure's on for 2026. And the CEO, Ramon Laguarta, he sounded like he's really stepping on the accelerator. The plan is, well, it's got a few key parts.
Okay, lay out for us.
First is what they call being brilliant at the basics. Get the simple stuff perfect.
Right.
Right price points, rock-solid service levels, flawless execution in stores, just nailing the fundamentals.
Table stakes, really, but necessary. What else?
Then big brand interventions. They're doing major relaunches.
Which ones?
3 huge ones in the U.S. and globally. Lay's, Tostitos, that's happening like right now, and Gatorade. That Gatorade one is slated for Q1 or Q2 next year, 2026.
And they feel good about relaunches because the Pepsi brand one worked.
Seems so. They called the Pepsi relaunch from about, 18 months ago, a major success, driving growth globally, especially the zero sugar stuff.
And in the U.S.?
In the U.S., they're focusing it on specific things like meal occasions and the away-from-home channel, restaurants, concessions, that sort of thing. They see that as a big growth area.
Okay, so core brand TLC.
Mm.
But the really big shift seems to be around innovation, particularly functional stuff.
Oh, absolutely. Innovation is key. And they're targeting these high-growth functional areas. Protein and fiber are the big two.
Protein we've heard about for years. What are they doing there?
Relaunching Muscle Milk, putting protein into Doritos and Quaker. Yes, protein Doritos.
Huh.
And developing a new Propel drink aimed right at GLP-1 consumers, the weight loss drug users. It's got electrolytes, high fiber, and protein. Really tailored.
Tailored is right.
Yeah.
But you mentioned fiber, and there was that quote from the CEO.
Yeah, that really jumped out. Laguarta straight up said, I think fiber will be the next protein.
Wow. That's a bold statement.
It is. It's not just a trend. He sees it as addressing a fundamental gap in people's diets globally, a structural opportunity.
So how does that translate into products beyond that Propel drink?
Well, it ties into this whole push for clean labels, too. They're launching a naked platform.
Naked, meaning?
No artificial colors, no artificial anything, basically. Starting with Lay's and Tostitos, rolling out through 2026. They're also playing with different oils, avocado oil, olive oil versions for their potato chips.
So innovation across ingredients, function, and the clean trend.
Exactly. And they're not just building it all themselves.
Right, M&A.
Yeah.
Acquisition.
Yep.
Boosting growth with recent buys like Poppi and C8. And they're using distribution deals, too, like bringing Alani Nu into their system later this year. It's all about speed to market and hitting those 2026 targets.
Okay. Lots of investment in new products, new brands, which inevitably costs money. So how do they square that with needing better margins? That brings us to the cost side, right?
Precisely. The cost transformation piece is critical. They were very clear. Overall, company margins will keep improving.
Driven by what?
International scaling helps, but critically, margin expansion in North America. Both Frito-Lay and PBNA are expected to improve profitability.
And how are they doing that, specifically in, say, Frito-Lay?
They're getting pretty surgical, closing down their oldest, least efficient factories, rationalizing their warehouse network, streamlining how products move around.
Makes sense. Anything else?
And right-sizing their go-to-market labor. Basically adjusting staffing levels now that the labor market is a bit more stable than it was. Okay, cutting costs. And that famous One North America idea, trying to merge the snacks and beverage supply chains. Is that happening everywhere?
Good question. They were careful about that. It's not a national one-size-fits-all plan.
No.
No, they're testing it very specifically, regionally, starting in Texas.
Texas. Why Texas?
Because it's a market, interestingly, where they have relatively low beverage market share, but huge snack share. So the idea is, in that specific kind of market, maybe putting snacks and drinks in the same warehouse, maybe on the same truck. Maybe that makes sense for the combined P&L, gives them an edge there.
So a very nuanced regional test, not a wholesale merger.
Exactly. Test and learn, focused approach.
And all these cuts, the efficiencies, the savings must be significant.
They expect them to be. The CFO mentioned a big carryover benefit from all this productivity work, especially hitting in the first half of 2026.
And what do they do with those savings? Just bank it?
No, reinvest. That's the plan. Plow it back into affordability for consumers, keeping prices accessible, and into A&M, advertising and marketing, to fuel that growth they need.
Got it. A cycle. Save money, reinvest to grow faster.
That's the strategy.
Okay, let's zoom out quickly. International. You mentioned deceleration in Q3.
Yeah, Q3 slowed down internationally.
Yeah.
Management mostly pointed to weather impacts in some big markets, but they did say September bounced back strongly.
But overall, the global consumer.
The takeaway was the consumer is stressed all over the world. That was the phrase used. They mentioned China specifically and linked Mexico's situation partly to remittance flows from the U.S.
Still, some bright spots.
Oh, yeah. India, the Middle East, still showing consistent, strong growth. So that long-term strategy of just building consumption habits internationally, that seems intact.
And circling back to where we started, that huge reported profit loss. Just to be clear, the big drivers were those impairments.
Yep. Primarily Rockstar and Be Cheery impairments. That was a huge chunk of the nearly $2 billion charge. Plus some other costs related to acquisitions and divestitures, like the Poppi deal integration, non-cash stuff, but it makes the reported GAAP number look pretty ugly.
Understood. And lastly, any big corporate context. Leadership changes, activists.
Two key things. One, the retirement of the long-serving CFO, Jamie Caulfield, done 3 years. His replacement is coming from outside the company.
Okay, new finance chief.
And two, they acknowledged the activist investor, Elliott Management, described the engagement as constructive and collaborative. So they both agree on the basic idea that PepsiCo stock is undervalued right now.
Interesting. So alignment there, at least publicly.
I think so.
Okay, so summing it all up, PepsiCo in Q3 2025, it looks like a company mid-transformation, right? They're deliberately trading some volume now for better pricing and profit.
Right, better revenue realization.
While simultaneously making these aggressive moves for the future. Supply chain consolidation, efficiency drives, and this huge push into functional innovation, protein, clean labels, and especially fiber, which I think is the next big thing.
It's all driven by this real sense of urgency to get back to that long-term growth algorithm in 2026.
Okay, so that leaves a fascinating question for you, the listener, to think about.
Given all this strategic betting on these new functional platforms like fiber and protein versus the big relaunches of established giants like Gatorade and Lay's, which of those levers do you think will actually be the most critical driver for them getting back on track next year? Is it the potentially higher reward, higher risk internal innovation? Or refreshing the tried and true core brands? Something to chew on.